I am here to bring you a special message brought to you by Master Investment Group. This is the retail bond monetization process, using leverage and margin to establish more buying power. When we are investing in the markets, or we're in our normal business practices in any business or market sector that you may be in, what is always prevalent is the need for capital as business opportunities arise, or maybe an emergency or something that was unforeseen that may come about. So having access to capital is very, very vital. And in this particular presentation, I'm going to actually break down how one can increase their buying power and leverage without increasing your margin or margin requirement. So without further ado, we will go to the retail bond monetization process. So, initial margin capital, $1,000. 1,000 leverage 4 times is 4,000. 4,000 leverage 4 times is 16,000. You leverage that 4 times, that's 64. 64 is 256. 256 is 1,024,000. And you do that one more time, you have now leveraged $1,000 into $4,096,000. So there you have it. Okay? And for those of you who aren't sure yet, or have trouble even putting together $1,000, let's talk about how we can turn $100 into $409,600 in just under a year. Effectively using leverage allows one to increase their buying power without increasing their margin requirements. So when you're dealing with a normal broker, if we're talking about the United States, a broker in the US will offer you what's known as 50 to 1. That means for every $1 that you put up, they will give you $50. If we're talking about abroad, brokers will give you what's known as 500 to 1. Okay? So that's 500 to 1. For every $1, they will give you $500. Okay? So this is abroad. Now, if we're talking about a bank, a local bank or credit union, without an established credit history, a local bank or credit union will offer you leverage of 1 to 1. That means you put up $1, they give you $1. Now in this scenario, you would think, okay, why would I even want to do this? And there's no reason to do it unless you're trying to establish credit. If I give my money to a broker and he doesn't give me any leverage, I am now introducing counterparty risk and paying fees to do so. You'll see that a lot when you talk about cost for margin in a cash account that doesn't have any leverage. These are typically going to be retirement accounts like 401ks and IRAs. So if we understand how banks work, if you've established credit with a bank, the bank will give you credit based on no margin requirement. Okay? That means the bank will give you what's known as a 1 to 0. For your credit history, the bank would be willing to lend you 1 unit. It could be 100,000, it could be $1 million, it could be $1,000. But you're putting up your credit to be able to obtain access to this capital. But a lot of times, if we don't have credit, then we're put in a situation where we're required to use cash, what's known as cash on delivery, okay, COD. So having access to more buying power without initial margin requirements is where this puts you. This means that the capital that's on the line, right, is not yours. You get access to obtain capital using just your personal guarantee. And your personal guarantee, it's much easier to replace if something goes wrong versus trying to replace capital that you have worked your whole adult life for. Your personal guarantee, i.e. your FICO score, it's worth nothing in a time of financial crisis when the banks are not willing to lend regardless of your creditworthiness or your willingness to put up a personal guarantee. So it's very, very important that you understand this. Okay? So in this example, I'm going to give you a masterful calculation, a very powerful tool where you can go in and you can take the leverage of 500 to 1, incorporate this 1 to 0, okay? Then take this 1 over here, in essence turning it into 500 to 0. How am I able to do that? Because, ladies and gentlemen, I'm about to go Danny DeVito on them. OPM, Other People's Money. I love that movie. So, you can almost create your own equation where it looks like this. Right? 500 to 1 to 0. In essence, I am using what? This to put up for that. If I get 100, let's say I get 1,000 from the bank. That means that I go over here and I'm going to have access to trade. If it's 50 to 1, I'll have 50,000. Okay? Okay? To my 1. If I'm talking about 500 to 1, like I show you up there, that's going to be 500K to my 1,000. I'm now putting up $1,000 to have access to $500,000. Follow me now. Follow me. So how do we accomplish this? Well, the first step to complete this process, you must open up a CD account under your business using the business's EIN, Employer Identification Number. Then deposit $100,000 into the business CD account. Now, I know some of you are thinking, wait, hold up. I don't have $100,000. I'm not going to get it anytime soon. I haven't even made $100,000 working at my job for the last couple of years. I understand a lot of us are in a situation where we probably make a lot less than $100,000 a year and probably have no way of even getting to it unless we use other avenues and resources. And I'm going to actually go into some of them, but the point I want to make is start where you are. It doesn't matter if it's $100,000, $10,000, or $1,000 or $100. Start where you are. Eventually you can build it up. So, with that being said, in this scenario we're going to use $100,000 as the example. Now you also want to have a reserve fund. That means I'm going to have about $20,000 that I'm going to put to the side. It doesn't have to be $20,000, it could be $2,000. It doesn't have to be $2,000, it could be $200. It's going to be relative to your situation. The point is I need to put money in reserve so that I can pay my payments in advance. I will explain here briefly. But I start with my initial capital. I take my initial capital and I'm going to go in and get a secured loan, a secured line of credit under my business. I'm then going to take money from my reserve fund that I have put away to service the loan, and I'm going to pay payments. Okay? Let's say hypothetically my payments are $5,000 for 6 months. Just hypothetically speaking. Okay? I'm going to pay 6 payments in advance, and these 6 payments are going to be paid separately. As a business, when you pay the payments in advance, it allows you to establish a higher Paydex score with Dun & Bradstreet, which is a business credit bureau, or you can establish a higher IntelliScore, which is with Experian Business Credit. Okay? Businesses are given COD, cash on delivery terms, if they don't have an established credit history. But once you establish an established credit history, they start giving you what's known as net 10, net 20, and net 30 terms. That means that you have 30 days with the net 30 terms to be able to go in, get some inventory, make money off of it before you actually have to pay for that inventory. Very nice situation to be in. And when you establish the credit this way, it puts you in a situation where you're kind of accelerating the credit building process by paying those payments in advance. Now what does this do to my loan? This takes my loan and it puts me in a situation where now the $100,000 I initially owed, I only owe $95,000. Since this $5,000 came from a reserve fund, I still have the full $100,000 secured loan that I can actually take, and I can go into a second bank. let's say that this bank was Bank of America. The second bank can be Wells Fargo, hypothetically speaking. Okay? I'm going to take this $100,000 and I'm going to go to the second bank, okay, which is Bank B, and I'm going to actually take that money and I'm going to deposit it with Bank B. Okay? Now, we have to open up a CD under the business, again, at Bank B. Before we deposit it, this is what we have to do, using the business's EIN. And then we deposit the $100,000 that we got as far as a secured loan from Bank A. Okay? Now, we then take an additional $5,000 from our reserve fund to service the debt. Okay? And we have to have that ready to the side so that we can go and pay our reserve payments. But I'm going to take that loan from the Bank A and deposit it into the CD account for the business under Bank B. And then I'm going to go and I'm going to get a secured loan. I take my reserve fund and I pay my payments in advance for 6 months, which then brings my loan balance down to $95,000. I only owe $95,000 at this point, but remember, I still have my $100,000 here that I have access to. I'm going to now take this $100,000 and you guessed it, you're right. I'm going to actually go on down to Bank C and I'm going to open up a business CD account using my business and its EIN, and I'm going to deposit that $100,000 with Bank C. I then get a secured line of credit from Bank C. I use the money from my reserve fund to do what? Remember, we're going to pay the payments in advance, which brings the loan balance down to $95,000. I've got access to this $100,000 that I'm going to now use to, you guessed it, go to one last bank. That last bank is Bank D. Bank D can be Citibank. Bank C could have been Chase. It doesn't really matter. The point is, go to the bank that you have an established relationship first. The banks that you have a relationship with, these banks are going to put you in a situation where it's going to be a lot easier for you to go from secured to unsecured because you've already established a relationship with them. So now, after going to this last bank, and I take the process around one more time, where I'm establishing a line of credit with this particular bank. Okay, I prepay my payment 6 months in advance, and then that puts my loan balance down to $95,000. Now, at this point, with the $100,000 that was deposited in the business CD that you've obtained from the business loan that you got from Bank D, you're going to take this to pay off the $95,000 from Bank A. This is using one-to-one leverage and is equivalent to a cash account, but the advantage here is your ability to gain access to more buying power through establishing solid payment history. Okay? Now, let's recap. All right, I would like to recap before we actually go through the next phase of the process, which is going around and actually paying off the full loan, closing the lines of credit down so we can get access to our capital and look at the nice house of credit we've built. So, to recap. You start out with the original bank, and at this point, remember, we've established 4 lines of credit at $100,000 each that are now reporting to the credit reporting agencies as paid as agreed. 6 payments, mind you, that are paid as agreed. Now, depending on your ability to negotiate, okay, you could go in and get, let's say, possibly a 0% no interest rate introductory period. Okay? If I'm able to do this, there is no interest that I'm paying while I'm running this process. And if there is interest, then some of it will be offset from the interest that you're making in the CD account. And if you're in the U.S., it's a reality of life that the interest that we make right now in CD accounts is not really that much. So, we started with the original loan that we went to Bank A with, got the secured loan, prepaid our payments to pay the loan down a bit, and then we go to Bank B. And when we go to Bank B, we end up putting up the $100,000 to get another secured loan. From there, I only owe $95,000 on that one, but I've got $100K that I take to the third bank, and I'm using that to establish a loan from the third bank. So from here, I use this money to go to the fourth bank and establish a loan at the fourth bank. But now I've got my $100,000 here that I can now start the second phase of the process to start paying these loans off. I have 4 lines of credit now established with 6 payment histories, 6 months payment history on each, and I only owe $95K, okay, on all 4. Now, I've got $100,000 in hand. I'm going to go from this point, and in the next phase of the process, it involves taking the capital from Bank D to pay off the remaining balance on Bank A's loan. Then you must close down the line of credit, combine the initial capital with the prepaid payments to pay off Bank B's loan, then repeat. So here's what it looks like. You take the capital from Bank D and you use it to pay off the $95K that you owe Bank A. That brings the balance to 0. It now frees up the capital on the secured loan, but in order for us to free up our $100,000 that we put in, we're going to have to close this line of credit down. Freeing up our capital, we can then combine that capital with the initial payment that we use to pay our payments in advance. That puts $105,000 in my hand. I'm going to take that $105,000 and I'm going to take it and I'm going to actually go to the next bank now. And I'm going to use this $105,000 to pay off the $95,000 that I owe Bank B. That brings the loan balance to 0, frees up the capital for the line of credit, and so that I'm not redundantly going back into the process, I have to close this line, freeing up my initial capital. When I combine this with my prepaid, the payments I use to prepay the loan, that brings me to $110,000. Because remember, I used $105,000 to pay off $95,000. Take this $110,000 and I'm going to take this $110,000 and I'm going to go to Bank C. And I'm going to use this $110,000 to pay off the $95,000 that I happen to owe Bank C. This will free up my money from my line of credit. I'm going to close down that line of credit, and when I close down that line of credit, it's going to free up what? My capital, the initial capital that I put in there. If I take this and I combine it with my money I used to establish the 6 payments that I paid in advance, this brings me to a total of $115,000. I'm going to use this $115,000 to make one last pit stop. One last pit stop before we head to profit land. Follow me. I'm going to take that $115,000 and I'm going to head on over to Bank D. They know who you are. You've been in there. So at this point, we're going to take that $115,000 that we have from Bank C's loan, okay, along with the money we used to prepay the loan, and we're going to make one final stop to pay off the loan balance that we owe Bank D, $95,000, which does what? It frees up our $100,000, and we close that line down, which is going to free up our initial capital that we put into Bank D. Now, when I combine this with my money I used to prepay the payments, it puts me in a situation where I'm back where I started now. But I'm in a better position because not only do I have my $120,000 in my pocket, but I've done what? At this point, I've got $120,000 in hand that I can now put in my wealth bucket, but I've got now also 4 new lines of credit established at $100,000 each that are now reporting to the business credit reporting agencies as paid, as agreed. So let's recap before we go through the final conclusion. So, after establishing the lines of credit with each bank, okay, I then go in and I pay off each loan. Close down the loans so I can free my capital up. Okay? Once I close the loans after paying them off, it puts me in a situation where I have my capital back in my hand, my $120,000. I can go buy gold or take this off the table and put it in a wealth bucket that I've got access to. Now, with 4 new lines of credit established at $100K each, there are now reporting the credit reporting agencies as paid as agreed. The banks will be willing to offer lines of credit in the amount of comparable credit that was established, which in this example was $100,000. When you multiply that by 4, it's $400,000. This example shows how one can go from 1-to-1 leverage to 4-to-1 leverage to 4-to-0 leverage, which increases, right, our buying power. So in essence, this gives me 4 times more buying power to operate with while retaining and protecting and preserving my initial margin capital investment. So again, I start with 1-to-1. That means I put up my 100K. I leverage this around 4 times, taking it 4-to-1. I then am able to take my 100,000 off the table and make it 4-to-0, right? So, matter of fact, we'll keep this so we show the progression. 4-to-1, and then bring it, next step, 4-to-0, because if I've established credit history going around building credit from these banks, they're going to be willing to lend money to me without my requirement to put up any margin, which now gives me 4 times more buying power and less risk. So, where does this then put me? Puts me in a situation where I've now got $400,000 in unsecured loans. Okay? Bank A is trying to give me 100K. Bank B wants to give me 100K. Bank C is lining up to give me 100K, as well as Bank D. Bank D wants to give me a little bit of money as well. Okay? All banks at this point are effectively willing to lend me money without any margin capital requirement. So, applying the reverse martingale strategy with leverage to obtain more margin puts you in a very powerful situation. So almost be just like the banker, or what we know, the firm we know to be a secured party creditor, so to speak. Okay? So let's talk about and recap. So with the initial margin of 100,000, instead of going directly to my broker, I can leverage it 4 times, put my 100 grand back in my pocket, and then be trading with 4 times the amount with no personal guarantee, because businesses are able to get non-recourse loans. I can start with my money and my credit and then move to a position where I'm not using my money or my personal credit, and it's just going to be relying on the credibility and ability to pay back the loans that the business has shown. If I go in and I buy Best Buy right now, it doesn't matter if the ownership has changed hands, Best Buy will always be able to go in and get lines of credit, because the credit is based on the business alone, not the owners and shareholders. So, starting out with 100,000, if I times that by 4, that's $400,000. You times 400,000 by 4, you get 1.6 million. You times 1.6 million by 4, you get 6.4 million. You times 6.4 million by 4, you get 25,600,000. You times that by 4, you get 102.4 million. And you do that one more time and times that by 4, you're looking at 409,600,000,000,000. Wow. What do I mean when I say this? If I go to the process of getting 400,000, instead of spending this or getting comfortable, I can go back to the same bank and run the process again to where now I've established my ability to pay 400,000 with 4 banks. Those 4 banks are then going to turn around and be willing to lend me what? Each one can lend me 400 grand. That's 1.6. I can take that 1.6 and go back to Bank A. Get 1.6 from Bank A, turn around and run it 4 times to where now I've established a $1.6 million line of credit and my ability to pay $1.6 million with 4 banks. Those 4 banks give me a total of $6.4 million combined. I can take that and go back to the original bank and start to repeat this process until I get to a position where I've got enough capital to meet my objectives and goals as a hedge fund, as a business, as a real estate investor, as a store that sells chairs, oil, or groceries. It doesn't matter what you are operating in business. It just puts you in a position of power, to have more buying power. And all this can be obtained through leverage. But some of you are saying, well, Reginald, I don't have $100,000. I'm lucky if I can scrape together $1,000, Reggie. I've got you covered. Initial margin capital, $1,000. 1,000 leverage 4 times is 4,000. 4,000 leverage 4 times is 16,000. You leverage that 4 times, that's 64. 64 is 256. 256 is 1,024,000. And you do that one more time, you have now leveraged $1,000 into $4,096,000. So there you have it. Okay? And for those of you who aren't sure yet, or have trouble even putting together $1,000, let's talk about how we can turn $100 into $409,600 in just under a year. $100 times 4 is 400. Okay? 400 times 4 is 1,600. You times that by 4, 6,400. You times that by 4, you get 25,600. From there, 102,400. And last but not least, you times that by 4, you have 409,600. And this person starts with $100, and you're now able to start exactly where that person was when they went in with $100,000, had money for reserve, and started to establish lines of credit that put them in a position where they were able to take this and do what? Go here. And it leverages all the way up until you feel that you reach the amount that you need to be able to be successful, live life, and leave benefits, not bills. There are also a lot of opportunities to arbitrage through certain things like carry trades, where you're taking advantage of interest rate differentials. I can take the money that I have and borrow a low-yielding currency in a low-yielding interest rate environment and invest it or put it in a CD in a different environment or a different jurisdiction where they're giving higher interest. Now, obviously, the risk involved is if the price on that particular security or a currency pair, shall I say, moves against me. But if I'm making interest on a day-to-day and there is no recourse for these loans, worst case scenario, I don't lose. I just get back on the horse, turn around, and make more investments to be able to put myself and my family ahead in this game of life. Same thing Bill Ackman has done, same thing Donald Trump has done, and many others before them. Again, my name is Reginald Ringgold, and I hope that you guys find this information very valuable. I'd like to say, salutations. So, let's go ahead and wrap this up. We'll go with, in conclusion, start where you are. Try to implement this process regardless whether you're starting with $100, $1,000, or $100,000. A lot of you already know of this process, probably implementing it personally on a personal level with a small amount of money using secured cards. Grow it. Take it to a level where you are able to go in and do bigger things, to be able to go in and change your family's financial situation so that you can go in and change your personal situation. Your why. A lot of us, our why could be to go in and go on vacation, to be able to have more income, to be able to take care of our families. We all have a different why. Having access to capital helps us take advantage of opportunities, but better yet, emergencies that may arise. So, continue the results if things go as proposed until you reach your desired margin capital goals. And then diversify the capital as well as your profits, and earn interest on the money into other assets or other mediums of exchange. Good examples, diversifying into Bitcoin. Or you can simply just pay off personal debt. Successful completion of this process will allow you to retain your capital for retirement or other opportunities that may arise, while still having access to more than enough buying power to invest in the capital markets. I mean, and before we do go, we'll touch on something that a lot of you, it probably did hit home: pay off personal debt. If I put myself in a situation where I've amassed, let's say, $5 million through the retail bond monetization process, this is $5 million that is unsecured. Okay? $5 million that is unsecured. Make sure that this is clean. Okay? $5 million unsecured. A lot of times, it's non-recourse, which means it requires no PG, no personal guarantee. Okay? So if I've got about $5 million that I've amassed in credit, I can go in and start paying off my house. If I pay off my house, now there is no lien on it. I still owe the money, but they're not coming to take my house if for some reason I can't pay the loan back. I can then turn around and do a process of what's called stripping the equity. It's in my book, chapter 14. You can go in and you can put a lien on the house for your own, from your own holding company that you may have offshore or wherever, but that property can be liened from an entity that you control, that you put a lien on. I typically put a lien for 125%. That means it's going to cover any equity that may appreciate as the property grows. But the beautiful thing is now my house is paid off. And the only person that I owe is an entity that I control. Own nothing, control everything. That's the name of the game. You can't squeeze blood out of a dry turnip. So with that being said, you have been equipped with enough power to go in and turn your financial situation around. I love you. If I didn't, I wouldn't be up here putting my neck on the line to show you how the powers that be are putting us in a situation where you have literally 1% that are sucking all the life out of the other 99%. And more specifically, we understand that there are those 5%. You know who you are, the poor righteous teachers. Okay? So obviously, I would like to say for those of you, take this very serious, because we don't know how much time we have before this whole thing comes unraveling. I'd like to say peace, Hotep, Salim, Shalom, and Godspeed. This is Reginald Ringgold, and I'm signing out.